Welcome to today's video. We'll explore the important concept of capital budgeting. This is a key process businesses use to make long-term investment decisions, like purchasing new machinery or expanding operations. Let's dive in. Capital budgeting is a process where companies decide whether to accept or reject a long-term investment project. These projects could involve buying new machinery, replacing old assets, or setting up new plants. Examples of capital expenditure include buying land or machinery, expanding existing business operations, and replacing outdated equipment. Now, capital budgeting projects are significant because they usually require a lot of investment, which cannot be easily reversed. Once the money is invested, it's often considered a sunk cost, meaning it's not recoverable unless the company takes a big loss. Let's look at the main methods used in capital budgeting. There are two broad categories: non-discounted and discounted techniques. Non-discounted techniques include the payback period, which tells us how long it takes for the initial investment to be recovered. For example, if we invest Rs. 12,000,000 and earn Rs. 3,000,000 per year, the payback period is 4 years. Simple, right? But there's a drawback: it doesn't consider the time value of money, nor does it account for cash flows beyond the payback period. Another method is the accounting rate of return, ARR, which measures the estimated profit of a project compared to the average investment. For example, if the ARR is higher than the required return, you should accept the project. Now let's discuss modern methods that account for the time value of money. Net present value, NPV, is the present value of all cash inflows minus cash outflows. If NPV is positive, it means the project is profitable. Internal rate of return, IRR, is the rate at which the present value of inflows equals outflows, essentially the break-even point. If IRR is higher than the required return, accept the project. Profitability Index, PI, gives a ratio of cash inflows to outflows. A PI greater than 1 means the project is good to go. One major criticism of IRR is that it assumes funds can be reinvested at the same rate, which isn't always realistic. Sometimes, a project can also have multiple IRRs, making the decision process tricky. Even after selecting a project, it's important to consider risks. The certainty equivalent approach adjusts cash flows by their likelihood of happening. We only consider cash inflows that are likely to occur. Sensitivity analysis tests how sensitive a project's outcome is to changes in key variables. If a slight change leads to big losses, that factor is highly sensitive. Finally, scenario analysis looks at different outcomes, best case, worst case, and most likely, to help a company prepare for various possibilities. Capital budgeting is a crucial tool for making smart investment decisions. By understanding the techniques and analyzing the risks, businesses can make informed choices that benefit their future. If you found this video helpful, make sure to like, share, and subscribe for more content on financial management and business strategies. Thank you for watching. If you enjoyed this video and found the content valuable, please consider subscribing to my channel, Chandra Shekher Research Academy of Business Studies. I regularly post insightful content on finance, business statistics, financial management, and operations research. By subscribing, you'll never miss out on updates, and it helps the channel grow. Also, don't forget to hit the notification bell and share the video with others who might benefit from it. Let's spread knowledge together.